Hello, Assalamualaikum everyone. My name is Muhammad Hassan and you are watching my YouTube channel Accounting with Hassan. Today's lecture is based on financial ratios. Financial ratios is based on tools and techniques that are used to convert financial statement data that facilitate analysis. What type of analysis or tools we are using here? That includes ratio analysis, common size analysis, graphical analysis, and regression analysis. Basically, the ratio analysis is based on four simple steps. The first step is based on liquidity ratios, and then the second one is based on activity ratios. The third one is based on profitability ratios, and the fourth one is based on solvency ratios. So what we are expecting here, the ratio analysis shows the future earnings and the cash flow of the company. It evaluates a firm flexibility, that whether the firm has the ability to grow and meet its obligations if an unexpected circumstance arises. The third one, and in the ratio analysis, we have to analyze the asset management performance of the company, and the fourth one is the liquidity ratios. Here we have to analyze whether the firm has the ability to pay its short-term obligations. So if you can see here how we can analyze the ratio analysis, we have to analyze the ratio analysis from the two different financial statements. One is called balance sheet, and the second one is called as income statement. Well, we have here a balance sheet that based on 2 years. When we are doing a ratio analysis, we have to compare a 2 years data, so we can understand then about the performance of the company. So we have an error of 2020 here and 2019, and we have a asset portion, we have a liabilities portion, then we have a owner's equity portion. The second one is based on, we have here an income statement analysis. That income statement is based on a multiple income statements. It includes cost of goods sold, it includes all operating expense, it includes income tax before income, and after we have to pay a tax how much income we have. Is that income is based on profit or we have a loss here. So these are two statements, and which we have to follow when we have to evaluate the ratio analysis. If you have a problem to identify the missing data that are not included in these statements, then we have to follow the notes to account. These all statements are available in the annual report of the company. So first of all, we have to talk about the liquidity ratios. Well, the liquidity ratios is mean that a company will able to pay its short-term obligations. The first one is current ratio. Current ratio is best known for its liquidity. So the current ratio is equal to current assets divided by current liabilities. And then how we can get that? For example, we have here assets portion. So we have here current assets here. Its total current assets 2,62,000. So we put here well 2,62,000, and then we have 1,42,000, and is the current liabilities. So we can get on the portion of the liability that is called total current liability 142,000. It's a data of 2020. Similar way to identify the values from 2009 data of balance sheet. So here there are two conditions: if the current ratio is higher than 1, or the current ratio is lower than 1. What is 1? That's an indicator that company has enough assets to maintain its normal. For example, in 2020 company ratio is 1.85, in 2019 company ratio is 1.87. So if we can analyze, we can say that in 2019 the company has a slightly better position than 2020. What's the interpretation of that analysis? So, for example, if the current ratio higher, it means the company has sufficient assets to maintain its normal obligations. And if the current ratio is less than 1, it means that the company has not a sufficient amount of current assets to maintain its normal business operations. But here in 2020-2019, company has a better, or I can say a sufficient current assets to maintain its normal business operations. So I can say that the current ratio, or the current ratio here in 2020-19 is much better than the industry average. The industry average here is 0.60. The in most of the cases, the industry average depend on the sectors. For example, service industry we have here, we have manufacturing here. So every industry have a different industry average. Okay, the second one we have here, asset test ratio. Asset test ratio, also called as quick ratio. For example, if the company can pay all its current liabilities if they came due immediately. So what we have include here, that include here cash including plus cash equivalents plus short-term investments plus how many net current receivables we have here divided by total liabilities we have here. So again, the data we have taken from the cash including cash equivalent that come from the asset portion. It is here cash equivalent, that's 29,000 we have here. And then we have here 19, and then again same short investment, we don't have value in the balance sheet, so we put we suppose as is a 0. So net current receivables, again where we get from the balance sheet. Here it is, that is 1,14,000. So divide by total current liabilities. So 2020 to 19, if you can see, the ratio is 1.01 and 2019 0.93. Now again, if we can see that if we can expect that a firm has a shoe retailer or a manufacturer of any equipment, and so the indicator is based on if the ratio is 0.20 to 1.20, then it is acceptable. So if you can see here in asset test ratio, we can see the asset test ratio. So we can say that the asset test ratio in 2020 and 2019 is slightly better and it's acceptable for a company. So we can see here, if it is better, then what's the reason? The reason is that the company can the company has a merchant inventory and prepaid expenses that are not including in the asset test ratio because they're the least liquid current assets. So that's the reason we have here for the asset test ratio or quick ratio. If I can summarize that, if the ratio is better, then a company can pay its current liabilities if they came due immediately. Okay. So the third one is based on inventory turnover ratio. Inventory turnover ratio measures the number of times the company can sell its average level of merchant inventory during a year. Again, if the ratio is higher, then it indicates the company can sell its merchandise inventory easily. If the company ratio is lower, then it indicates a difficulty to sell its merchandise inventory. So one formula is here, inventory turnover is equal to cost of goods sold divided by average merchant inventory. So the cost of, for example, the cost of goods sold of 2020 is based on income statement. So it is 13,000 divided by average. Average means the year of we have to add some 20 and some 19 data, divide by 2, then we have 4.58. This 4.58 value indicates the company can sold its average level of merchandise inventory 4 times, once every 3 months a year. Okay. So now we have to find out another ratio that is called day sales in inventory. Well, that's the key measure ratio, and this ratio measures a number of days merchandise inventory held by the company. So again, if we can see here, the formula is day sales inventory is equal to 365 days divided by inventory turnover. If you can see here, 2020 the days is 365 and 4.5. How we can get it? We can get from the previous ratio that is called inventory turnover. Here the ratio is 4.58. So we'll put here a value of 4.58. Then in 2020 the ratio is 79.7 days. Again, we didn't take the value from 19 because inventory to inventory turnover ratio we have to take an average of both year. That's why we have to include only 2020 data. So industry average equal to 13 days, but here the days inventory of that company is 79 point, approximately 80 days. So what it indicates? It indicates that a company day sales inventory of 79.7 days is too high for industry. So it identified that the company needs to improve, and that the company should focus for reducing average merchandising inventory. By decreasing this inventory, the company can increase its inventory turnover and lower the average day sales in the merchandise inventory. If we can able to reduce that inventory, then what would happen? Then the inventory storage and the insurance costs, as well as reduce the risk of holding obsolete merchant inventory. For example, if there is inventory where we have a risk to that it can be obsolete, so we have to hold for less days. Okay, so the ratio is account receivable turnover ratio. Account receivable turnover ratio shows that a company collects the average receivables balance in a year. It means if the ratio is higher, the company can collect the collections in the form of cash, and it can be collected rather faster. However, receivables is too high may indicate a company credit policy is too tight. Now, if you can see here, account receivable turnover ratio equal to net credit sale divided by average net account receivables. Again, we have to get this net credit sales value from the income statement. Here's a value. If you can see here, net credit sales, that is called, we have here 8,58,000 we have here. So we have to put this value here, and then we have to average net account. Again, we have to take 2020-19 data divided by 8.6. So what it shows? So it shows that that a smart touch learning company and accounts but 8.6 times per year, which is very much lower than the industry average. So why the difference? What happened? So the smart touch learning company is fairly new business that sells and established people to pay their accounts over time. So the turnover coincides with the lower than the average industry. So if the smart touch learning have a higher account receivable turnover, that it here have to increase its inventory turnover ratio. So it means that account receivable turnover ratio is based on inventory turnover ratio. If they have to improve their ratio, then they have to increase their inventory turnover ratio, which we have discussed already in above here, inventory turnover ratio. Okay, so now we are focused on day sales receivables. So day sales is basically called as a collection period, which indicates that how many days it takes to collect the average level of receivables as in a year. Okay, so if you can see here, if the collection period is shorter, it means the company can quickly organize its cash, and that if the collection period is longer, it means the company has a less cash, and it can be a difficult situation if they can maintain the operation for operations. So it means that the company, the shorter period in the collection receivables is much acceptable as compared to longer period. So we have a formula here, day sales receivable divided 365 days divided by account turnover ratio. So we have here 265 days, and then we calculate account receivable turnover ratio here, that is called 8.6. the value is 42.4 days. What it tells? It tells that that the average day sales remains in account receivable and needs to be collected. So the company, it indicates that the company's sales receivables is very much higher, and it's in a worse condition. If that can reduce to less than 25 days, it means the company can collect their receivables in quick succession, and it can help to maintain the daily operations of the company. So another ratio is based on debt ratio. Well, it shows a relationship between total liabilities and total assets. So what it shows if the debt ratio is 100%, then all assets are financed with debt. Similar, if for example, if you have a debt ratio is 100% of the company, and then it means that all the assets are financed with debt, then how we can indicate? Indicate for there are two possibilities. If the debt ratio is 50, what indicates means half the assets are financed with debt and other half are financed with the owner of the business. The higher the debt ratio, the higher the company's financial risk. It means that if the debt ratio is lower, it means that there's a less risk of companies, that the less risk of in the company. So what it evaluates, the debt ratio evaluates the company business ability to pay its debt. So what a formula is, total liabilities divided by total assets. So we have put here these are values of 2019. So if you can see here that 54.58, 54.8% and then 50.3% in the 2019. So what it shows, what it indicates here, it indicates here that if the debt ratio is high, it means that the company has a financial risk. So if, for example, if the company has less debt ratio, it means company can pay its debts very easily and it's not in a financial risk. So if you can compare here, the industry average in this sector is 69%. So the company is slightly better than as compared to the industry average. So now we are going to discuss about profit margin ratios, that is based on profitability ratios. So what is the profit margin ratio? The profit margin ratios shows here how much net income a business earns on every $1 sales of the sales. This ratio focus on profitable business, and the smartest profit ratio as follows. So we have here 2 years ratios on 20 and 19. Formula is net income divided by net sales revenue we have here. So we can calculate 5.6% and 3.2%. So what indicates? Again, we have two conditions: if we have a high profit margin or if we have lower margin. If we have a higher profit margin, then what it indicates? It means that is more sale dollars and the profit. It will mean the increase in the smart learning is that the increase in the smart touch learning profit margin ratio from 2019 to 20 is significant, and identified that the company has more successful than the average learning providers, where profit ratio is 1.75. What indicates? It means that 2020 is much better than 2019, and if the profit margin ratio is higher, it means that company's net sales revenue is also very higher. And if the company's ratio is below than industry average, it means that there's a issue in the sales of the product of the company. So we follow here, and the next one, that is called rate of return on total assets. What it includes? It includes to find out that the company's success in using its assets to earn a profit. So there are two ways that a company can finance it. One is called debt, other one is called equity. What is the difference between debt and equity? A company can borrow cash from creditors to purchase assets. The creditors can earn interest on money that is loan. Equity: a company receive cash or other assets from a stockholder. Stockholders invest in the company and hope to receive return on investment. So basically, if a person, for example, if a person who is taking a loan from a bank, so what would happen? That a person who get a money and the bank and get a interest on it. So equity means that the owner or the stockholder invests in the company and hope to receive the returns on their investment, which invest in the company in future. So rate on return on total assets, we have calculate here. So if you can see a formula, net income plus interest expense divided by average total assets. So in 2020 we have here net income. How we can get net income? We can get from the income statement. The interest expense we get from the income statement, and average total assets, we added, we have total assets of 2019, we added it divided by 2, then we get a 10.1%. So what it called here, it showed that the total asset number is much better than the industry average. And what we have here, that it is a better in the return on total assets, company has a better position in form of net income. Now asset turnover ratio, what we call here asset turnover ratio, measures the amount of net sales revenue from each average dollar of the total asset invested. For example, there is this ratio. What this ratio measures? it measures how well a company using assets to generate sales revenue. Simple the concept is then how many assets we are using to generate its sales revenue. For example, asset test ratio, turnover ratio is equal to net sales revenue divided by average total assets. So that is called is 858,000 from the net sales revenue, that from income statement, and average total sales we have included here, that is called 1.20 times. So if you compare the industry average with the 2020 data of asset turnover, it shows a lower than the industry average, that is 3.52 times. So what it shows that the company is generating less net sales revenue for each average dollar of total asset. Normally companies have high gross profit percentage and will have low asset turnover. So if the company have low gross profit percentage, will have a high asset turnover ratios. So this is another area where the company has to increase its sales and decrease its average total assets to improve this ratio. So we have another ratio that is based on return on common stock equity we have here. Okay, then we have the most important one is the EPS, earning price per share. If you can see here, what earning price is not the ratio that appears in the financial statement. Earning share price reports the amount of net income or net loss for each share of the company from its company outstanding common stock. Well, here there are two types of common stock. One is called a common stock, and then it's called a preferred stock. Has a right, the company right of ownership, where he can buy and sell the share in the market. That's called common stock. So here, if you can find out the value here, that earning per share net income minus preferred dividend divided by a weighted average number of common stock share outstanding. So we have calculated here, instead 20 is 4.80 and instead 19 is 2. If we can evaluate this data, then we can say that 2020 the earning price ratio is increased, and to 19 the earning price per share is decreased to 2.60, but the industry average is 9.76 per share. So what it indicates? It indicates means that the stockholders should not expect this boost on EPS every year. Most companies strive to increase EPS by 10 to 15% annually, and leading companies to do so. So therefore, smart touch learning company needs to work on continue to increase its EPS by increasing its net income. So if we can see that basic reason, that if the earning price per share is increased, if we have to increase the earning price per share, then we have to increase the net income of the company. And finally, I have put all the formulas sheet in my video. So these are all ratios these are all ratios with formulas and the description. And here it is. If you have any question, and please let me know in the comments. If you think that this lecture is beneficial for you, and subscribe my channel, like it and share it. And thank you very much.